Welcome to the Explainer. So, if the economy is a ship heading straight into a storm, what exactly is Bitcoin? Is it a lifeboat or is it an anchor? Today, we're building a risk management playbook for Bitcoin, breaking down the economic forecast and what its wild history really tells us about what could be coming next.
And we're going to kick things off with this warning from the legendary investor Ray Dalio. It just perfectly captures that core fear behind an economic crisis, right? That moment where the whole system just grinds to a halt. The train stops. So that's the environment we need to map out before we can even begin to place Bitcoin on it.
To really get a handle on that risk, first we have to understand the environment itself. And, some economists see the economy moving in these massive long-term cycles, kind of like the seasons of the year.
Yeah, this theory is called chondriactive waves. And the idea is that economies go through these long phases, right? You get a spring of recovery, a summer where things start to overheat, an autumn full of financial bubbles, and then a really painful winter of debt deflation and crisis. It's basically a framework for thinking about where we might be in the grand scheme of things.
So the billion-dollar question is, what season are we in right now? Well, if you look at the warning signs, things like record high government debt, a lot of analysts are arguing we're in a late autumn, or maybe even an early winter. And that precarious phase, that's the essential backdrop for how we have to think about risk.
Okay, so if we are heading into some kind of economic winter, you'd naturally start looking for a safe place to hide, a safe haven. But let's take a really hard look at how Bitcoin has actually behaved in past storms.
The popular story you always hear is that Bitcoin is digital gold. The idea is it's this stable asset that's going to protect you when everything else is falling apart. But does its history actually back that up?
The data here pretty much speaks for itself. I mean, look at this timeline. A 93% drop in 2011, 85% in 2015, 84% in 2018. These are not minor corrections. These are absolutely catastrophic declines. This history directly challenges that whole idea of Bitcoin being a stable store of value.
And here's the kicker. These massive drops, they aren't bugs. They're a core feature of Bitcoin's history. Every single cycle has ended with this kind of deep, prolonged, painful capitulation before the next one could even begin.
So all of this leads us to a much more nuanced picture. See, Bitcoin's behavior in a crisis isn't just one single story. It's more like a two-act play. It has this kind of dual personality with two very, very distinct phases.
And here is that split personality in action. During the initial shock, think back to the March 2020 crash, Bitcoin sells off, and it sells off hard, right along with everything else as investors just panic and run to cash. But after the shock, when governments and central banks respond with huge stimulus packages, it becomes what's called a high convexity asset. Now that's just a fancy way of saying it has the potential to rally incredibly hard and incredibly fast, far outpacing other assets.
Okay, so let's reframe this. Bitcoin isn't a shield you hold during the crisis. It's better to think of it as a high-risk, high-reward bet on the response to the crisis. You're not betting on stability. You're actually betting that the government's solution will be to print more money and inject massive stimulus into the economy.
So, given that Bitcoin has this complex, dual nature, how can an investor actually prepare for a potential downturn? What's the playbook here?
Well, first, let's just take a quick look at the traditional world. For bond investors who are staring down a recession, the playbook is really well established. It's all about safety. You shorten the maturity of your bonds, and you stick to only the highest quality stuff to minimize your risk.
But, and this is a big but, trying to apply that same defensive logic to Bitcoin would be a huge mistake. It is a completely different kind of asset, and it needs a completely different set of rules for risk management.
Which brings us to a four-step playbook for Bitcoin. Number 1. Assume volatility. Don't just tolerate it, actually expect it. 2. Maintain liquidity. This means you need cash on the sidelines because when everyone else is forced to sell in a panic, that becomes your opportunity. 3. Size for tail risk. Your allocation has to be small enough that an 80% drawdown doesn't completely wipe you out of the game. And finally, number 4, differentiate. You have to know the difference between the initial shock where you need to be defensive and the policy response that follows, which is the time to be opportunistic.
So let's wrap all this up by zooming out and just thinking about what this dual personality really means for Bitcoin's role in the whole global financial system.
This quote really captures the modern thesis perfectly. Bitcoin is not a calm port in a storm. It's more like a high-stakes bet that the tools governments will use to fight the storm, things like quantitative easing and massive spending, will ultimately be inflationary and devalue traditional currencies.
And this leaves us with one final and I think provocative thought. Maybe we've been measuring Bitcoin against the wrong thing this whole time. In an era of what feels like constant crisis and response, maybe its real job isn't to be a stable asset, but to act as a real-time barometer of our collective faith, or lack thereof, in the stability of the entire system.